Imagine watching your paycheck melt away every month, not because you spent it on groceries or rent,
but because a hidden part of it is siphoned off by mandatory social contributions that many of us accept without question.
It feels like a silent thief, and the worst part is that most people believe there's no way to stop it.
What if I told you that a significant slice of those deductions can be legally reduced or even avoided without breaking any law?
In the next few minutes, I'm going to walk you through the real reasons why we paychecks shrink, how the legal framework actually works,
and the practical steps you can take to keep more of your hard-earned money.
First, let's define what we mean by mandatory social expenses. In most countries, these include contributions to Social Security, health insurance, pension funds, and sometimes union dues.
They are often presented as non-negotiable, a compulsory part of any employment contract. The feeling of being forced into them is reinforced by the fear of penalties, the complexity of the tax code, and a cultural norm that tells us that's just how it works.
Most workers never question whether the percentages they pay are truly applied to their situation, and they simply sign away a chunk of their salary each month. But the law is not as monolithic as it appears. There are layers of regulation that differentiate between statutory obligations and contractual agreements. Statutory contributions are set by the government and apply to all workers within a certain category, but even those can have thresholds, exemptions, and alternative regimes. Contractual contributions, on the other hand, are negotiated between employer and employee and can sometimes be adjusted or replaced with different arrangements. Understanding where the line is drawn is the first step toward taking control of your finances. One common misconception is that every employee must contribute a fixed percentage of their salary to Social Security, regardless of how much they earn. In reality, the percentage can vary depending on the sector, the income ceiling, and the type of contract you hold. For example, certain small business regimes allow a lower base contribution, and self-employed professionals often have the option to calculate their contributions on a declared income rather than a fixed salary. These nuances are hidden in the fine print of labor laws, but they exist and they matter. Now, let's talk about the opt-out possibilities that many people overlook. If you are self-employed and your annual revenue falls below a specific threshold, you may be eligible to join a simplified contribution scheme that reduces the amount you owe. Some countries also offer voluntary exemption for workers in creative or freelance fields, provided they meet certain criteria such as having a limited number of employees or operating under a specific tax regime. The key is to identify which category you belong to and then verify whether the law permits a lower contribution rate for that category.
Of course, there are risks if you step outside the legal boundaries. Non-compliance can lead to hefty fines, loss of future benefits, and even legal action.
That's why it's essential to stay within the safe zone defined limits. A practical tip is to keep a contribution tracker, a simple spreadsheet where you log every deduction, the legal basis for it, and the deadlines for any required filings.
This not only helps you stay organized, but also makes it easier to spot opportunities for reduction.
Now that we have a clearer picture of the legal landscape, let's explore how the way you are hired can dramatically change the amount you pay. The distinction between being an employee and being a freelancer is more than just a label. It determines which contribution formulas apply to you. Employees typically have their Social Security contributions calculated on their gross salary, which includes a mandatory employer share that you indirectly pay for. Freelancers, however, usually calculate contributions based on the net income they declare, and they can often choose a lower base rate if they qualify for a simplified scheme. If you are currently an employee, one strategy is to negotiate a contract that classifies you as an independent contractor for certain projects. This can be done by setting up a limited liability company or a sole proprietorship, depending on the jurisdiction, and then invoicing your employer for the work you do. By doing so, you shift the responsibility of paying the employer's share of contributions to yourself.
But you also gain the ability to deduct business expenses before calculating your contribution base.
Common deductible expenses include office supplies, a portion of your home internet bill, travel costs, and even a percentage of your rent if you work from a home office. These deductions lower your declared income, which in turn reduces the amount you owe to the Social Security system. Another avenue is to join a professional association that offers a collective insurance plan. In many places, these associations provide health coverage and pension options that are often cheaper than the standard public schemes. By opting into the association's plan, you can sometimes reduce or replace the mandatory public contributions, especially if the association's rates are recognized by the government agencies as an acceptable alternative. This requires careful research to ensure the association's benefits meet your needs, but it can be a powerful way to cut costs. A third option is to take advantage of special tax regimes designed for small businesses and startups.
These regimes often feature reduced contribution rates for the first few years of operation, as an incentive to encourage entrepreneurship.
If you are willing to register your activity under one of these regimes, you can benefit from lower Social Security payments while still maintaining legal compliance.
The catch is that you must meet the eligibility criteria, which typically include limits on the number of employees, annual turnover, and the type of services you provide.
All of these strategies hinge on a solid understanding of the legal framework and a willingness to restructure how you receive income. It may feel daunting at first, but the potential savings are significant.
Imagine a freelancer who, by switching to a simplified contribution scheme and deducting legitimate business expenses, reduces his Social Security payments by nearly a third. That extra cash can be reinvested in his business, saved for retirement, or simply used to improve his quality of life.
What do you think about these possibilities? Let me know in the comments. I'm really curious about your perspective and any experiences you might have had with adjusting your contributions.
In the next part, we'll dive deeper into specific tax deductions you can claim, explore private insurance alternatives that can replace public mandates,
and walk through a step-by-step case study that shows exactly how to implement these changes without triggering any penalties.
Stay tuned, because the final strategy ties everything together and could be the game changer you've been waiting for. If this is opening your eyes, hit that subscribe button and let's keep exploring together.
Now that we have set the stage, let's dive into the concrete tax deductions you can claim, explore private insurance alternatives that can replace public mandates, and walk through a step-by-step case study that shows exactly how to implement these changes without triggering any penalties. Stay with me, because the final strategy ties everything together and could be the game changer you've been waiting for. First, let's talk about the tax deductions that are often overlooked but can dramatically lower the base on which your social contributions are calculated. The most common deduction is the cost of a home office. If you dedicate a specific room or a clearly defined area of your home to work, you can allocate a portion of your rent or mortgage interest, utilities, and internet service to your business expenses. The key is to keep a detailed log of the square footage used for work versus the total living space, and to retain all invoices and bills.
By doing this, you can reduce your taxable income by a meaningful amount, which in turn lowers the percentage you owe to the Social Security system.
Next are equipment and technology purchases. Anything you buy to perform your professional duties, computers, monitors, printers, software licenses, even ergonomic chairs can be written off as a business expense. The tax code allows you to either expense the full cost in the year of purchase or spread it over several years through depreciation.
For most freelancers and small business owners, the immediate expense method is the simplest and yields the quickest reduction in taxable income.
Just make sure the items are used primarily for work and keep the receipts in an organized folder, either digital or physical. Travel expenses are another goldmine. If you attend conferences, meet clients, or conduct site visits, the costs of transportation, lodging, meals, and even incidental expenses can be deducted. The rule of thumb is that the travel must be directly related to your business activities, and you must be able to demonstrate the purpose of each trip. A simple spreadsheet that logs the date, destination, purpose, and amount spent will satisfy the tax authority and give you a clear picture of how much you are saving each month. Professional development is often ignored as a deductible expense, but it is fully allowable.
Courses, certifications, webinars, and even books that enhance your skills can be claimed.
The logic is that these investments increase your earning potential, so the tax code encourages you to invest in yourself. Keep the enrollment confirmations, receipts, and any certificates you receive, and you'll have a solid paper trail. Health insurance premiums are a special category. While many people think that paying for health coverage is a mandatory expense that cannot be reduced,
the tax code actually permits you to deduct the portion of premiums you pay out of pocket if you are self-employed.
this deduction is taken on your personal tax return and directly reduces your adjusted gross income, which again lowers the base for social contributions.
If you have a spouse or dependents covered under the same plan, you can often include their premiums as well, provided you are the primary policyholder.
Retirement contributions are another lever you can pull. Contributions to a qualified retirement plan, such as an individual retirement account or a simplified employee pension, are deductible up to a certain limit. By funneling a portion of your earnings into a retirement vehicle, you not only secure your future but also shrink the amount of income that the Social Security system sees as subject to contributions. The key is to choose a plan that is recognized by the tax authority and to make regular contributions throughout the year. Now that we have covered the main categories of deductions, let's shift gears and examine private insurance alternatives that can replace or supplement the public mandates. One popular option is a private health insurance plan that offers broader coverage, shorter wait times, and the ability to tailor benefits to your specific needs. When you switch to a private plan, you can often negotiate a lower contribution rate with the Social Security system, especially if you can demonstrate that your private coverage meets or exceeds the statutory minimum. This requires careful research to ensure the private plan is recognized by the relevant government agencies as an acceptable alternative. It also means you need to keep proof of coverage and payment records, but the potential savings can be substantial. Another alternative is a supplemental pension scheme offered by professional associations or private insurers. These schemes allow you to build an additional retirement fund that is not subject to the standard Social Security contribution rates.
By contributing to a supplemental pension, you can reduce the amount you owe to the mandatory system while still ensuring a comfortable retirement.
The trade-off is that you must meet the eligibility criteria of the private scheme, which often includes a minimum contribution amount and a commitment to stay enrolled for a certain number of years. Union fees are sometimes perceived as unavoidable,
but many workers discover that they can join a different professional association that offers similar networking and advocacy benefits at a lower cost.
In some of these associations, the membership dues are considered a business expense and can be deducted, further reducing your taxable income.
The trick is to verify that the association's rates are recognized by the government agencies as an acceptable alternative.
This requires careful research to ensure the association's benefits meet your needs, but it can be a powerful way to cut costs. A third option is to take advantage of special tax regimes designed for small businesses and startups.
These regimes often feature reduced contribution rates for the first few years of operation, as an incentive to encourage entrepreneurship.
If you are willing to register your activity under one of these regimes, you can benefit from lower Social Security payments while still maintaining legal compliance.
The catch is that you must meet the eligibility criteria, which typically include limits on the number of employees, annual turnover, and the type of services you provide.
All of these strategies hinge on a solid understanding of the legal framework and a willingness to restructure how you receive income. It may feel daunting at first, but the potential savings are significant.
Imagine a freelancer who, by switching to a simplified contribution scheme and deducting legitimate business expenses, reduces his Social Security payments by nearly a third. That extra cash can be reinvested in his business, saved for retirement, or simply used to improve his quality of life.
What do you think about these possibilities?
Let me know in the comments. I'm really curious about your perspective and any experiences you might have had with adjusting your contributions.
Now, let's walk through a real-world case study that puts all of these ideas into practice. Meet Alex, a graphic designer who started his freelance career 3 years ago.
When Alex first began, he was classified as a standard employee under a temporary contract, which meant he paid the full statutory rate for Social Security, health insurance, and pension contributions.
He was also paying a union fee that he never really used. After a year of barely breaking even, Alex decided to explore his options.
Step 1 for Alex was to evaluate his current contribution structure. He gathered his pay slips, identified the exact percentages he was paying for each mandatory item, and calculated the total amount leaving his pocket each month.
He then compared this figure with his net earnings after business expenses. The gap was larger than he was comfortable with, so he moved on to Step 2.
Step 2 involved choosing a more favorable legal regime. Alex discovered that, as a self-employed professional with an annual turnover below a certain threshold,
he could register under a simplified contribution scheme that capped his Social Security base at a lower level.
He consulted a tax advisor, filled out the necessary registration forms, and officially changed his status to an independent contractor.
This shift alone reduced his mandatory contribution rate by roughly 20%.
Step 3 was all about maximizing deductions. Alex created a dedicated home office in a spare bedroom, measured the square footage, and allocated a proportionate share of his rent, electricity, and internet costs to his business. He also purchased a high-resolution monitor, a graphics tablet, and a subscription to a premium design software suite, all of which he logged as equipment expenses. For each client meeting that required travel, he kept receipts for mileage, fuel, and meals.
Over the course of a year, these deductions shaved off a substantial portion of his taxable income.
Step 4 focused on private alternatives. Alex switched from the public health plan to a private health insurance policy that offered comprehensive coverage and lower monthly premiums. He provided the necessary documentation to the Social Security office, proving that his private plan met the statutory requirements. In addition, he joined a professional association for designers that charged a modest annual fee, which he could deduct as a business expense,
thereby eliminating the higher union fee he had been paying.
Step 5 was about retirement planning. Alex opened a personal retirement account that allowed him to contribute a portion of his earnings pre-tax.
These contributions were deductible, further reducing his taxable base.
He set up an automatic monthly transfer, ensuring consistent savings without having to think about it each month. Finally, Step 6 involved ongoing monitoring. Alex created a simple spreadsheet that tracked his income, expenses, contributions, and deductions. He reviewed it at the end of each month, making sure that all receipts were filed and that he stayed within the limits of his chosen regime. By staying organized, he avoided any accidental overpayment or compliance issues.
When Alex compared his new contribution totals to his original figures, he discovered that he was paying roughly 30% less in mandatory social expenses. That translated into an extra few $100s each month, which he used to upgrade his equipment, take a short vacation, and build a modest emergency fund.
Alex's story illustrates how a systematic approach understanding the law, restructuring your status, leveraging deductions, and opting for private alternatives can produce real, tangible savings. Now that you have seen how Alex turned the system to his advantage, let's bring everything together with the final, overarching strategy that ties all of these elements into a single, cohesive plan. The core idea is to create a layered income structure that separates your earnings into distinct buckets, each optimized for the lowest possible contribution rate while still complying with the law. The first bucket is your core professional income, which you receive through a formal business entity such as a limited liability company registered under the simplified contribution regime. This bucket is subject to the reduced base rate, and you can further lower it by applying all the deductions we discussed: home office, equipment, travel, professional development, health premiums, and retirement contributions. Because the entity is a separate legal person, you can also pay yourself a modest salary that stays within the low contribution threshold, while any excess profit can be distributed as dividends, which are taxed at a different, often lower, rate and are not subject to the same Social Security contributions. The second bucket consists of ancillary income streams that are not directly tied to your primary profession. For example, you might earn royalties from selling digital assets, receive affiliate commissions, or collect rental income from a property you own. These streams can be reported under a different tax classification that may have its own set of contribution rules, often more favorable than the standard employee rate. By keeping these incomes separate, you avoid inflating the base used to calculate your mandatory contributions.